Hey, it's Jim, and this is level 1 of the CFA program, the topic on corporate issuers, and the learning module on investors and other stakeholders. Before I get to the 3 LOSs in this learning module, let's begin by describing the story of Milton Hershey. About 150 years ago, this dude created a caramel company, sold it after a couple years, and started making chocolate in Hershey, Pennsylvania. Now, I'm hoping that you guys have had this beautiful chocolate, Hershey Kisses, Hershey chocolate bars. But think about what Milton Hershey has done over the years. He has expanded the Milton Hershey Foods product lines by introducing these new product lines himself, or buying other corporations that have different kinds of chocolate and other confectionery related product lines. So the question that we're asking, in not only in this topic, corporate issuers, but in this learning module, investors, is where has Milton Hershey obtained his capital to finance the expansion, whether it's a geographic expansion throughout the United States and throughout the world, or product line expansion? And the obvious answer to this question is that, well, hopefully Milton Hershey has generated lots and lots of operating cash flows so that it can finance that expansion. And of course, some of that capital comes internally. But what we're focused on here in this learning module is external financing. And so that first part of the learning module title, Investors, that is a reference specifically to the bondholders and the shareholders. So I'm going to give you just a little mini lecture here that I tell my students all the time. And if my students pay attention to anything that I say over the course of a semester, this is one of those things that they'll remember by the end of the semester and even after they graduate. So key questions here inside of this learning module for the CFA Level 1 exam would be, what's the difference between a bondholder and a shareholder? So let me tell you, when Milton Hershey and other corporate issuing executives, when they issue a bond, they essentially pick up the phone and call the bondholders and say, hey, can you lend us some of your hard-earned capital so that we can finance this expansion? And the bondholders say to Milton Hershey and all of these other executives, they say, well, what are you going to do with our money specifically? And what do we get out of it? And here's the key. Milton Hershey and these executives say, I promise to pay you interest and pay you principal. This is an explicit promise. It's a legal and binding contract. Interest and principal. Now, on the other hand, when Milton Hershey borrows money from the shareholders, he picks up the phone and calls the shareholders and says, hey, can you lend me some of your hard-earned capital to finance this expansion? The shareholders ask the same question. They say, can you be more specific about what you're going to do with our capital and what do we get out of it? And Milton Hershey and these other executives, they do not make an explicit promise. They make, and this is Jim's term here, they make a vague promise. They say something like, you know what? I'm going to take your money and I'm going to invest it in this wealth increasing project. And if I'm successful, I might pay you a dividend. Plus, you might be able to go to the floor of the New York Stock Exchange and generate a capital gain. The difference between the two promises, an explicit promise and a vague promise. And there's a second part to this as well. If Milton Hershey fails to deliver on that explicit promise to the bondholders have a course of action. They can take Milton Hershey to court and force Milton Hershey to sell his assets so that the bondholders can recover some of their investment. But if Milton Hershey fails on the vague promise, the shareholders, they have no course of action. That's why investing in shares of stock is more risky than investing in bonds. Now, there are lots of other layers to this, but it all comes down to the promise made by the executives to the bondholders and the shareholders. And you'll see that theme as we go through this relatively short slide deck. So here are the LOSs. So compare financial claims, right? Lenders and shareholders, right? Bondholders and shareholders. And then we'll go ahead at the end and talk about different stakeholders, and then we'll have a brief conversation on ESG. So here we go. Here's a couple of slides that are really just kind of summarizing what I said in the introduction. All right, so what are the bondholders? The reading calls them debt holders. And so what that means is that they could be both short-term debt, maybe we'll call it a note holder. Maybe it could even be a bank loan, a finite term financial capital to a company. So what did I say earlier? The explicit promise. I promise to pay you interest and principal over the next finite term. And so bonds can be issued with maturity dates of 5 years or 10 years, 20 years. 30 years seems to be a common maturity date for bonds. There's nothing really interesting about 30 years. Back in the late 1990s, both Coca-Cola and Walt Disney issued 100-year bonds, right? So look at it says, in that second teardrop point, regular interest payments repay the principal on predetermined dates. That's the explicit promise made by Milton Hershey to the bondholders. And by the way, in that introduction, when I said something like, what does Milton do? He picks up the phone and calls the bondholders, picks up the phone and calls the shareholders. Of course, he doesn't do that, but it's a good image. It's a good visualization, so you get to understand the relationship between the issuer and the ultimate investors. Remember, we had a conversation on primary markets and secondary markets. And of course, all of this occurs with the help of, at least most of the time it occurs with the help of an investment banking firm. Bondholders, look at the green teardrop point, do not possess decision-making authority. Of course, that's true. And there are some tax implications to being a bondholder. Of course, if you receive these interest payments, that probably goes somewhere on some kind of a tax form as income. But what's cool about this for the executives and the accountants for these corporate issuers is that those interest payments show up on the income statement. So when you subtract out an interest expense on the left-hand side of the income statement, what that essentially does is lower the tax liability. What that means then is there is a tax advantage of issuing debt. How about shareholders, on the other hand? Notice the Institute uses the term permanent capital. That's because shares do not have a maturity date. What did I say earlier? I make you a vague promise. I promise that if I do well, I'll pay you a dividend. But remember, I don't have to pay you a dividend. And by the way, if you want your money back, you're going to have to go somewhere else. And that somewhere else is the secondary market. That's the floor of the New York Stock Exchange. So this is a great exam question here. Bondholders provide a finite term because on the maturity date, the bondholders receive their principal payment. There is no maturity date for shareholders, so there is no principal payment to shareholders. Look at the second teardrop point. They do not commit to providing future dividends or repayments to shareholders. There's that vague promise that I was referring to earlier. So you might be asking yourself the question, all right, if it's a vague promise, if I might lose all of my money, why am I going to do this? And the answer is, well, you have the best chance of buying low and selling high with a share of stock. You have a much greater expected or required rate of return. So becoming a shareholder means that you have a right to receive any dividend payments if the board of directors declares and pays those dividend payments. But more importantly, what it means is that as a shareholder, you have a claim on the company's operating cash flows. You have a claim, which means that that claim has to be materialized through the executives and the board of directors. So that's essentially what you're doing. As when you become a shareholder, you're saying to Milton Hershey, here, take all my money, go ahead and invest it in new chocolate bars. And when you're profitable, then go ahead and throw those profits back into the equity portion of the balance sheet. And as that equity portion of the balance sheet swells, what the executives can do is pay the shareholders a dividend, or the shareholders can go to the floor of the New York Stock Exchange and generate a capital gain because new shareholders will be willing to pay more for that swollen equity portion of the balance sheet. Notice the green teardrop point. I said this earlier, discretion of the board of directors. So it's the board that decides whether or not to make that dividend payment. This claim is a residual claim because on the income statement, right, we've got revenues up on the top right, and then down on the left, we have all of these organizations and people to whom we owe. So on the left-hand side of the income statement, what do we have? We have labor expense, we have rent expense. Milton Hershey has chocolate expense and milk expense and sugar expense and all those expenses. So once all those expenses are paid, then at the bottom we have net income. And that net income then gets moved over to the equity portion of the balance sheet by the accountants. And so we have that residual claim. So that's what the word residual means, after we pay everybody else to whom we owe. Here's a little table that summarizes what we've been talking about over the last several minutes. My advice is to go ahead and get your phones out again, take a picture of this, and put it in some folder that you can look at pretty regularly. So this is a summary table, should be fine. Now let's continue this conversation about risk. What did I say a few moments ago? That the risk of being a shareholder is much greater than the risk of being a bondholder. Now, that's coupled with the concept that when you become a shareholder, let's suppose that you invest $10,000 in Milton Hershey. What's the most you can lose? The most you can lose is if that stock price falls to zero on the floor of the New York Stock Exchange, you lose the entire $10,000. So that's that first bullet point. Maximum loss is capped at the investment. However, suppose Milton Hershey takes your capital and my capital and invests in this chocolate bar and that chocolate bar, and the cash flows are huge. Let me just pick a number. $1 trillion in operating cash flows for 1 year. I mean, imagine that. What would happen on the floor of the New York Stock Exchange? Boy, everybody would be showing up and everybody would be wanting to buy. So what happens to the price in the secondary market? So there's no limit on the gains if the company succeeds. Now, what are the risks? Stocks are riskier since no contractual obligation is set. All right, you see how my introduction is really helping us understand this LOS, right? The bondholders get an explicit, legal and binding promise from the executives. In other words, what that means is that when Milton Hershey generates these cash flows, what he has to do is he has to pay all of the bondholders first. Wow, this is called leverage. So if Milton Hershey has tons of leverage, then the bondholders, the shareholders, that residual claim is only on the amount after all of the bondholders have been paid. Equity holders may lose entire investments if the company goes bankrupt, right? Okay, Jim, that's a really smart comment. Here's a cool graph. We're going to use this graph not only today, but, and let's not worry about this just immediately, we're going to use this graph when we have conversations about options later on in level 1 and then expanding into level 2 and in level 3. So it's important to get your phone out, take a picture of this slide. So notice what we're doing. On the vertical axis, we have our shareholder gain or loss. So we can either go to the New York Stock Exchange and generate a capital gain, go to the New York Stock Exchange and generate a capital loss. On the horizontal axis is the value of the firm, future value of the firm. Now, what we're going to learn primarily in level 2, but a little bit in level 1, there are these two guys in 1958. They're considered to be the fathers of corporate finance. Their names are Modigliani and Miller. What they taught us back in 1958 was that the value of the firm is a combination. It's a sum of the value of the bonds and the value of the equity. So future value of the firm, that's why we have those two dotted lines down on the bottom horizontal axis. All right, so what's happening here? Think about Milton Hershey and he issues a bunch of bonds. Let's just pick a number, say it's 100. And he issues a bunch of shares of stock. Let's just pick a number. Let's say it's 50. All right, so what is the debt plus the equity? That's 150. So what's the most that we can lose? All right, well, what's happening here? Notice down in the left-hand triangle and the left-hand rectangle that's shaded in red, these are the losses. All right, so what did I say earlier? $10,000 invested in Milton Hershey, that's the most that you can lose. But then what happens? As soon as you hit the value of the bonds down there at that inflection point, the value of the firm is increasing. So what that means is that value of the firm depends on the ability to generate operating cash flows. So as Milton Hershey sells more and more chocolate bars, we have that 45-degree angle going up, and we hit a break-even point. The value of the debt and the value of the equity, there we are at zero. But then what happens? There's the green triangle. That's the unlimited upside. So what's the goal of the business? The goal of the business is to maximize the value of the firm. What that means is that executives make decisions so that they invest in product lines that are going to become or expected to become branded product lines, right? The Milton Hershey Kiss, right? The chocolate kisses. This is a brand name product line. Milton Hershey's been selling these things for over 100 years. He's probably going to be selling these things for hundreds of more years. All right, so notice we have over in that gray box, equity holders are interested in the continuous maximization of the company's net value. Oh my gosh, that's so cool. This is a great lesson to learn now. What are we trying to do? What is Milton Hershey trying to do? Continuous maximization. That means that Milton Hershey shows up for work every day and he continuously attempts to find product lines that are going to become brand names, so that the cash flows are sustainable. Boy, that's a super important word. Now, what about the bondholders here? They have a priority, right? The bondholders, this is what I was saying earlier, because it's an explicit promise, the bondholders get paid before the shareholders. But if the company is profitable, wait a minute, let's go back here. Let me point to a line on the horizontal axis that's way over to the right. You move up with that to the green triangle. As a shareholder, you get to share in the future profitability of the company. Not so as a bondholder, right? Your promise is fixed. I promise to pay you interest, and I promise to pay you principal. And in parentheses, although this is not stated explicitly, in parentheses, it's written, and no more. I am contractually obligated to pay you interest and principal, but if I'm super successful, this is all you get. This is the beauty of leverage. So this is what I want to do. Let's suppose I'm Milton Hershey and I borrow $100 from you guys, and I invest it in a chocolate bar over here, and I make, let me just pick a number. I make $1 billion on your $100, and I promise to pay you 10%. So think about what happens. I borrowed $100 from you. I generated $1 billion, and I take $100 out of that billion, and I repay you your principal. Then I take 10, let's say it's a 10% interest rate, and I give you your interest. So I paid you interest and principal, but I used your capital to increase the wealth of the owners. That's what's going on here over on this right-hand side with the green triangle. This is called the beauty of leverage. Now, what's the ugliness of leverage? Well, this can be summarized as that if I take your $100 and I invest it in, how about if I say a broccoli chocolate bar, and it's disgusting and nobody buys this chocolate bar, and I have to declare bankruptcy. So I took your money, I invested it in a wealth decreasing product line, and it brought the company down. It bankrupted the company. So then what happens? Well, here it is. Let me go back here quickly. Well, what happens is that we're over here on the left-hand red shaded rectangle for both the bondholders and the shareholders. Nobody's happy, right? The ugliness of leverage, bondholders are not happy, although bondholders can receive some of their losses back when the company is forced to sell the assets. But think about this. How much is Milton Hershey going to be able to sell his broccoli chocolate making machine for? So it's going to be way discounted. So look at that triangle point down there. I'm sorry, the diamond point, right? Investment is lower for bondholders than equity holders because the bondholders value is supported by the assets of the company. All right, so this return profile, go ahead and get your phone out, take a picture of this. This is similar, but not identical to the bondholders. Of course, it can't be identical. So what's happening? We still have that triangular loss. So let me go back here to this one. There's that triangular loss again. So what's the most that the bondholders can lose? Well, that original investment, same thing as with the shareholders, but notice the green profit gain, or the gain is fixed. So no matter how profitable the firm is, the bondholders only get their $100 plus their $10 in my example. Notice over in the gray box, this is just a couple of bullet points that are summaries of what I have been saying before. Notice down that bottom right there, default risk. This is an important concept. Default risk to the bondholder is the risk that the executives will not make either the interest or the principal payments. So the next question then becomes, what's the difference between, and how do we determine whether we have the beauty of leverage or the ugliness of leverage? In other words, how do we evaluate the default risk of a particular company and of a particular bond issue? Now, of course, what you're learning in the CFA program is going to give you the toolbox for you to be able to personally make a determination of the soundness. But of course, what we tend to do is rely on these credit ratings agencies like Moody's and Standard & Poor's. And so this debt soundness, this debt rating, this credit rating is typically based on, well, we have 3 points here: creditworthiness, willingness to repay the debt, cash flow, quality of collateral, probability of default, and the loss given default. And by the way, we're going to go ahead at some point in the CFA program, we're going to have to compute the probability of default and that loss given default. But just remember those definitions now. So let me go over those, kind of quickly here. So think of creditworthiness of a corporation as, what does the balance sheet look like? What do the assets look like? What do the liabilities look like? What does the equity look like? In other words, what are those assets over on the left-hand side of the balance sheet? And what is their ability to generate cash flow? That's the second one right there. Now, the willingness to repay the debt, remember that, this is a contractual obligation. So Milton Hershey is legally obligated to make this payment. But Milton Hershey might wake up one day and say, you know what? I don't like those bondholders over there. I'm not going to pay them. Let them take me to court. I have really, really smart men and women as lawyers. I'll go ahead and defeat them. Well, he probably won't be able to defeat him, but maybe he'll be able to delay. So there is that side of the willingness to repay the debt. And by the way, when I refer to Milton Hershey, I mean, he's been gone for probably, I don't know, when did I think he died right after World War II. So when I say he wakes up, I kind of mean the executives. Quality of collateral. This is an important concept. You think about this. Those of you who live in the United States and who have gone to Hershey Park, you'll know that you can take a tour. So you can actually see these chocolate making machines. And so if Milton Hershey woke up today and said, you know what? I'm tired of making chocolate. I'm going to go ahead and sell these machines. Well, he would probably command a high price for those machines, which means they are a high quality of collateral. And then what bondholders tend to attempt to learn is the probability of default. In other words, what is the likelihood that Milton Hershey is going to default on the interest or the principal payments? And that probability of default, it depends on the creditworthiness, it depends on the cash flow. And this is how I always tell students, and you probably seen me do this in a previous recording. Suppose that the bond issue is this big and the cash flows are this big. What's the probability of default? Super low, right? But if the bond issue is this big and the cash flows are this big, then the probability of default is probably higher. And so just remember, those two ranges. I think you'll be able to answer any questions that the Institute can throw at you. But then this concept of the loss given default depends entirely on the quality of collateral. So I think that's a really great exam question. Probability of default depends on cash flow. Loss given default depends on the quality of the collateral. All right, how about this risk return profile from Milton Hershey's perspective? All right, so what did I say at the very beginning? I said that if Milton Hershey is looking for capital to finance an expansion, he's probably going to look at the firm's internally generated operating cash flow, right? But that's probably not realistic because most firms don't generate tons and tons of cash flow. And these capital budgeting projects are in the hundreds of millions of dollars, if not billions of dollars. So it's probably not realistic and it's probably not efficient as well. So Milton Hershey and these corporations, they appeal to the bondholders and the shareholders. But the cost of debt is lower. There's no doubt about it that the yield to maturity on the bonds is lower than the required return on the share of stock. Now, couple that with when a corporation issues additional shares of stock, it dilutes the ownership. I mean, that makes perfect sense. You know, you take a look at a company like Milton Hershey or Johnson & Johnson or Procter & Gamble. I mean, they literally have, billions of outstanding shares. So every time they issue shares of stock, that ownership is spread in a wider dispersion of shareholders. So that's what that term dilution means. You look at that bottom diamond point. Bondholders elevate the risk to the corporation by increasing leverage. This is what I was talking about earlier. This is a great sentence. What did I do? I took your $100, I invested in an asset, and I generated, $1 billion. All right, so what that means is that I'm increasing the risk to the corporation. Now, of course, my example is a silly one. $100 versus $1 billion, but suppose it's $100 and $200. All right, so increasing leverage. Remember that. There's the beauty side of leverage, and then there's the ugliness side of leverage. Now, one of the really, really cool things that I learned that I had never heard of back when I was in my PhD program is this concept of the conflict between and among different investors on the right-hand side of the balance sheet. So bondholders and shareholders, what is their goal? Well, the goal of the bondholders and the shareholders is to invest in wealth increasing projects. Now that might sound an awful lot like the bondholders and the shareholders want the same thing, but this is not true. This is clearly not true. Remember, both groups can lose their entire investment. However, it's only the shareholders that get to share in the company's future profitability. So let's go back to my Milton Hershey example. You guys are the bondholders, and I'll represent the shareholders. So Milton Hershey, he wakes up today and says something like, you know what, I'd like to expand. What do you guys as the bondholders want? Well, you want Milton Hershey to build a plant over there that's going to expand and make more Hershey Kisses. That's a branded product line. What do we know? If Milton Hershey makes 100,000 Hershey Kisses today, he knows that he's going to be able to sell them, right? There's the branded power of that product line. So as a bondholder, you want the executives to invest in those branded product lines because they have relatively low risk. Oh my gosh. But what do I want as a shareholder? I don't want that. About 20 years ago, Milton Hershey woke up one day and said, you know what? I'm kind of tired of making chocolate. I'm going to make a breath mint. So what did the bondholders and the shareholders say to Milton Hershey? What do you know about fresh breath? You know about the chocolate and you know about the caramel. Milton Hershey says, well, I'll hire some chemists and I'll hire some scientists and I'll figure out how to make a breath mint. As a shareholder, I was delighted when Milton Hershey decided to make icebreakers. It was a riskier project, right? What I want to do, and I think it's worth going back here just quickly. What I want Milton Hershey to do is take extra risk by shooting off the branded product lines into other more risky product lines so that I can capture that green triangle over there on the top right. So what happened? Milton Hershey started making these icebreakers. Icebreakers now, 20 years later, is its own branded product line. So this is really the great exam question. Look at the 2 diamond points at the bottom. Bondholders prefer the company to invest in less risky projects with certain cash flows. This means they're branded product lines. Notice what it says next. To secure, right? Bondholders, they don't want any risk because they don't get to share in the profitability of the firm. Now, the cool thing from the bondholder's perspective is that they can't control the executives and the board of directors in terms of their decision making. But what they can do is they can craft positive and negative covenants that become part of the debt contract that the executives sign when they make that explicit contract. It's called the bond indenture. And so what those covenants can be is those covenants sound an awful lot like, hey, Milton Hershey, we know that you've made an explicit promise to us, but we also know that the shareholders want you to invest in risky projects. So before you invest in those risky projects, we're going to require, according to the terms of the contract, we're going to require that you do the following things. Some of these covenants are positive, like maintain a current ratio of 1.25. Some of them are negative covenants that sound like you cannot pay a dividend to the shareholders until you pay us our coupon payment and you've set aside a bunch of money so that we can receive our principal payments on the maturity date. That's called a sinking fund provision. We'll learn, I did go forward here quickly. We'll learn more, more about those covenants as we move through the program. All right, let's move on to the next LOS here. Let's talk about stakeholder groups. So what do we know? We know from our previous discussion that bondholders and shareholders are super important components of this corporate structure. But they're not the only components that are important. So in corporate governance, we need to worry about other stakeholders. And who are these other stakeholders? These stakeholders are groups or organizations that have a stake in the success of the corporation. So notice the first one that's listed, investors, right? And then creditors. We talked about banks, but that also includes private lenders. And then you have the executive leadership team and you have the suppliers. Now, what the Institute does is, they say suppliers, and they typically mean anybody over on the left-hand side that does stuff and supplies that stuff to the company. But I'm going to appeal to those of you who have access to Bloomberg Terminal. Have you used the supply chain function? This is what I want you to do. Pause the video right now and get into Bloomberg and type in, just do Milton Hershey. Type in Milton Hershey and look in supply chain. This is so cool. What you'll see in the middle is Hershey Foods. And then on the left side is a list of all of the companies that provide goods and services to Hershey Foods. And then on the right-hand side, you'll see a list of company to whom Milton Hershey sells his goods and services to. And so that supply chain function is really cool. So I mentioned that to you just so when you see the word suppliers, you think of people on the left-hand side, but don't forget the people on the right-hand side of the supply chain. And then, of course, we talked about the board of directors. Let's not forget customers, governments, and regulators. All right, I think this is a really super important part of this learning module. Great question on the exam. Compare shareholder theory versus stakeholder theory. Remember a few moments ago I told you about these two dudes, Modigliani and Miller. They really began this idea of what's the goal of the business is to maximize shareholder wealth. How do firms do that? They invest in projects that are going to expected to have lots and lots of sustainable cash flows, right? That's the whole idea about these branded product lines. In the shareholder theory, the goal of the business is based on the financial decisions and the financial components of this process of making not only capital budgeting decisions, but capital structure decisions as well. So look what we have in bold. This is important. Considered only to the degree that they have an impact on shareholder value. So these are financial decisions. But stakeholder theory, on the other hand, and this has taken on a pretty substantial role in the last decade or so. What we're saying here is that these stakeholders are important and should be important in the capital structure and capital budgeting decision-making process that the executives go through. Now, the idea here is that the executives, what's the goal of the business? They should still maximize shareholder wealth, but they should also include non-financial decisions, environment, social, governance. In other words, this stakeholder theory says, yes, let's go ahead and maximize the value of the firm, but let's make certain that the banks and private lenders, that the financial institution industry can support us and that we can make decisions so that our value increases to support them as well. It's kind of like a give and take. Not just managers, but all employees, right? What do we want to do? We want to put together a system under which we have fair compensation. We want to be competitive. We want to pay our CEO, our executives, our high-level managers, and our employees. We want them to be satisfied with their compensation packages. We want to make certain that the people on the left, the people on the right of our supply chain, that they're satisfied with our outshoot, to the right and to the left. We want to elect a board of directors that is going to be dedicated to all of this stuff that we're talking about. So the issue with stakeholder theory is let's maximize shareholder wealth, but let's not do it at the expense of these other stakeholders. All right, so you got the difference between those two. Now let's go and look at some of the problems. Wow. What we're doing is comparing non-financial and financial decisions. So we might have multiple objectives. I mean, let's think about this. Take a company like ExxonMobil. What do we know about ExxonMobil? They've been around for thousands of years, and what do? They get their shovels out and they dig in the ground and they get stuff out of the ground. What is that stuff? Natural gas, oil, anything that comes out of the ground that can be transformed into energy so that we can air condition our homes and drive our cars and fly on airplanes. But now look what we have there, ESG. What about shareholders who say something like, well, we need to protect the planet, we need to worry about carbon, we need to worry about all these kinds of things. So balancing multiple objectives is a huge issue inside of this stakeholder theory. Who gets to determine those multiple objectives? That's another part of the story as well. So look at the second one there, defining and measuring these non-shareholder objectives. Now, of course, another problem is that we have to worry about something like the following. Let's go back to Milton Hershey. Suppose Milton Hershey decides to become carbon neutral in 10 years or 20 years, whatever that goal might be. Well, what happens if other chocolate companies don't follow suit? Well, if Milton Hershey is expending company resources to meet those goals and the competition is not, then when people like you and I, now, I hold the charter. You guys are hoping to hold the charter. I'm just assuming that you're going to pass level 1, level 2, and level 3. Sooner or later, we're going to be evaluating these two companies. And the competitors, they might look more profitable than Milton Hershey. All right, so do not follow similar standards, considering these increase a company's cost. All right, so that's a problem there. All right, let's go ahead and take a look at these different stakeholders in particular. I'm going to quickly go through these slides because we've talked about this over the last 30 minutes or so. So the investors, who are these? Bondholders and shareholders. So what do we know? Shareholders, they represent the ownership of the corporation. They get to share in the current and future profitability of the company. There's that residual claim down there. Now, some shareholders are referred to as majority shareholders, in which they hold over 51% of the shares of the company, which means they have total control of the board of directors. But controlling shareholders is a term used to describe shareholders who have enough ownership to influence what goes on at the annual meetings. Minority shareholders have limited ability to exercise control. All right, how about bondholders? So you have these private bondholders. That includes banks, any kind of a financial institution, insurance companies, credit facilities. The public bondholders, those are people like you and me, individual bondholders, but they include institutional investors like a mutual fund or a pension fund or an endowment fund. And then, of course, asset managers. Bondholders have little to no authority over the operations. You can't be a bondholder and show up at the annual meeting and say, hey, I'm Jimmy the bondholder. You should listen to me. I think you should invest in a chocolate broccoli candy bar. You might laugh at that, but I guarantee you there's somebody out there that would love to have a broccoli flavored chocolate bar. All right, board of directors. I will say this, that about a third of my dissertation was written on board of directors. So I did tons and tons of research. Now, of course, this is my PhD is 1993, so that was a long, long time ago. So what is the board? The board of directors is a group of really, really smart men and women who are elected by the shareholders. So this is important. The shareholders are owners. And what they do is they elect a really talented board of directors who essentially have two jobs. Now, what the Institute says in this learning module, protecting shareholder interest, hiring the CEO, monitoring performance. So I'm going to give this to you in a little bit different terminology. The board of directors has two responsibilities. You ready for this? Establishing the strategic direction of the company. What does that mean? That means that it's the board who will determine which product lines that the executives will invest and which product lines that the executives will reject. Now, of course, the board doesn't have to come up with these ideas. The executives will approach the board and say, hey, this is what we're thinking. What is your idea? You know, think of a company like Johnson & Johnson. What does Johnson & Johnson do? They do three things, right? They do the consumer products, and they do the vaccines and all the stuff that goes on, and they do replacement parts. I currently have a Johnson & Johnson titanium hip. You know, so that's the strategic direction of the company. So suppose Johnson & Johnson woke up one morning and said, you know what, let's make some chocolate bars. Well, that would have to come from a combination of the executives and the board of directors redefining the strategic plan. So that's the first thing. So that's a part of protecting shareholder interests. The second part is hiring and firing the executive leadership team, primarily the chief executive officer. And then the hiring and the firing, that implies the monitoring performance. I'm going to go ahead and add one to this. This is so important, is that one of the chief sub-goals of the board of directors is to craft compensation packages for the executive leadership team that is competitive, but will motivate the executives to make wealth maximizing decisions. All right, a couple of different types of board. A single tier board. You know, this board includes both executive directors and non-executive directors. So this is important. In fact, you go back to the 1990s. There was a dude from the New York Stock Exchange, one of my favorite executives, who pretty much led this charge. He said something like, and I'm paraphrasing here, if this company wants to be traded and listed on the New York Stock Exchange, it has to have at least 50% of independent members. And if you do a quick search, and my advice, I show pictures of the Johnson & Johnson board to my students every semester. Johnson & Johnson has 12 or 13 board members. Only one of them is an internal board member. The rest of them are external or independent. And so this is really the future of boards, that they should have a overwhelming majority of independent members. Now, we can have a two-tiered board. We can have a management board and a supervisory board, which kind of separates those two functions in a more formal manner. Most corporations have board members who are elected annually. And so if you look at the proxy statement, there'll be a note that says something like, hey, on the agenda, we're going to go ahead and elect the board members. If this Johnson & Johnson, let's say, here are these 12 or 13 individuals, we recommend that you vote for them, and they will serve for 1 year. The overwhelming majority of companies have this. It's called straight voting. But lots of firms have, and this is a little bit more common than it was when I wrote my dissertation, is this concept of a staggered board. Back in the old days, we called it a classified board. And so what happens is that we classify board members into different classes or groups. So let's just take a quick example. Suppose we have 6 board seats. So under that first straight voting, those 6 individuals, they would be reelected every year. So if I wanted to take over this company, all I would have to do is get enough shares, and I could vote those 6 people off, and I could vote me and 5 of my family members and friends, and I could take over that board. But suppose it's a staggered board, and I say, look, these 2 people here are Class A, these 2 people here are Class B, and these 2 people here are Class C, and each of them serves 2-year terms. So if you're elected, you serve for 2 years. This is called a staggered board. So what happens then, if I want to take over this company, even if I have 100% of the votes, there are only 2 board seats available, so I can only vote myself and, let's say, my wife onto that board. I only now have 2/6. I don't have control. And so that's why we have these staggered boards to prevent a takeover. The advantage, continuity of the company's leadership. Disadvantages, swift and major change. So that should make perfect sense. Customers, yes. So what are we doing? Whenever we go to the food store, what are we buying? We go and we buy some shampoo, right? That's made by Procter & Gamble or Johnson & Johnson. And what are we expecting? Well, when we buy that shampoo and we take it home and we bathe our 1-month-old, what are we hoping? The tears, they get in their eyes, but what does Johnson & Johnson say? No more tears. So what's the goal here? The goal is to maximize shareholder wealth, but we need to make certain that we have products that deliver what we promise and are safe. That's super important. Suppliers, what was I saying earlier? Remember, left side of the supply chain and also the right side of the supply chain. Notice that's important there, ability to generate sufficient cash flows so that we can pay all of those people who supply to us. Governments, of course, we need to be aware of the laws, not just from a safety standpoint, which is what I was talking about with the customers, but from tax laws to contractual laws to maybe even retirements, et cetera, et cetera. Managers, right, implementing the company strategy. We said that earlier. Employees. So that makes perfect sense there. So let's go ahead and end with a couple of slides on these environmental, social, and governance factors as they relate to the bondholders and the shareholders. So remember what I was saying earlier is that we're trying to consider non-financial factors, ESG, coupled with the financial decision making of which product lines to invest in and which to not invest in. So look at that, kind of light blue box there. Setting goals regarding operating, investing, and financing decisions. Now, what we're going to do in a learning module here in just a little bit is we're going to look at financial statement analysis, and we're going to look at the cash flow statement, and we're going to talk about operating cash flows, investing cash flows, and financing cash flows. And we're going to see exactly how these ESG factors relate to not only current profitability, but future profitability as well. So let's just quickly go through these ESG. So what are the environmental factors that we should consider? Scarcity of resources, waste management. I'm hoping that some of you are golf fans. There's a company out there that sponsors a golf tournament on the PGA Tour, and boy, they have a lot of fun. There's a hole on this course. It's a par 3, and when the golfers hit it on the hole, if they get close to the hole, the fans, they scream their guts out. If it's a hole-in-one, they throw water bottles on the green. So I love this part of water scarcity and waste management, probably energy efficiency as well, coupled with the professional sports world. Deforestation, air and water pollution, climate change, of course. Social issues, these are in the front of our brains here because we as a society are becoming more and more sensitive to all of these factors that surround us. Couple of more important ones here from a financial standpoint are that occupational health and safety and customer satisfaction and product responsibility. So think about that left-hand side of the supply chain and how that relates to the goal of the business to maximize shareholder wealth. Governance, this has everything to do with the board of directors and how it is structured and how the board decisions get filtered down through all of these other social and environmental issues. I mean, what was I saying earlier? It's up to the board to determine the strategic direction. So we could have a board that, well, let's just suppose that they are super sensitive about labor standards. Let's just pick one of these social issues. And so this board of directors may recommend or impose policies that have these extra standards. Now, the question then becomes, are those extra standards, are they going to make our labor force more satisfied so that they're more productive, or are they going to be a drain on the income statement? So these are huge marginal cost, marginal benefit issues. Whistleblowers, this thing is super popular, especially in the political environment. For those of you who pay attention to that in the early 2020s, shareholder rights and bribery and corruption. So this is a summary slide on exactly what I was saying here just a second ago. We've got to weigh the marginal costs with the marginal benefits. Notice some of the words that we have in bold, right? These ESG factors must be quantified. It's not sufficient just to say, you know what, in my heart, I know this is the right thing. As a board member or a CEO, well, let's go ahead and try to translate or transfer that feeling in our heart or soul into some type of a quantifiable, a measurable, either marginal cost or marginal benefit, and then decide how it impacts our cash flows. Look at the conclusion down there. Assess the potential positive and negative effects. So what does this mean for an exam question? Oh boy, this is really cool. Think about first sentence that says something like, hey, and what was I saying earlier? Let me just go back here. What did I pick? Labor standards. So the top of the question says something about labor standards, and we think it's going to improve by this and this. And then the next sentence says something like, oh, well, here are some of the consequences. Maybe they're a negative externality because of this. And the question is, what do we do? And the answer has to be, well, marginal costs, marginal benefits. So assess the positive and negative effects. But remember this is probably key to answering the exam question, how those positivities and negativities, how they impact not only all the ratios, but projected financial statements, which means current financial statements and future financial statements as well. All right, so this was fun for me. I love talking about bondholders and shareholders. I love talking about financial decisions and the potential of non-financial factors influencing those financial decisions. So thanks for watching. Have a great day and good luck studying.